Hello, real estate professionals. This is Andy O'Fee, the Yankee closer from Crump Mortgage with a 2018 forecast. As I'm sure most of us are aware, we had a great year as far as housing goes. Productivity on my side was at a historically high level also. So thank you for all those who participated. Last year at this time, we made some very bold predictions. We talked about the housing market. We talked about the Fed and what they were going to do as far as raising short-term rates. We also talked about our interest rates. One thing we did miss out on was calling a running stock market. As of the end of the first week of January, we have broken the 25,000 barrier on the Dow Jones. The NASDAQ and the S&P have also hit historical highs, but we're all going to be taking advantage of that, making more money in our investments, and that's also helping buyers out too. But I want to go ahead and let's go ahead and take a look into the crystal ball for 2018 and give you an idea of what I'm going to forecast as what we're going to expect to see in our market and how it's going to impact us right now. Let's go ahead and take a look into our crystal ball. We have the housing market, we have rates, we have a bull and a bear market. Let's go ahead and see what's actually going to happen going into the next year. So the 2018 dynamics that I really want everyone to focus on is the stock market being the first point. Everyone has been taking advantage of this market as it's been running. We again went through 25,000 on the Dow, actually an incredible number if you have anything else to say about it. It's really just flat out incredible. But I think right now the market's very top heavy, and I think we could see a pullback in the market, and that ultimately will impact housing. Now, how will that impact housing? Well, people will ultimately have less money to invest, and they may have second thoughts about making probably the largest investment opportunity they have and or will make in their entire life. But when we see stocks pull back, we have a tendency to see money go back into the rate market, so that will definitely help our rates out as we go forward. The Fed is going through a significant change. Also, the president must appoint several new members. We're going to take a look at that in a little bit. But right now, they're indicating that 3 rate hikes is on schedule for next year, actually for 2018. And the big thing I think we need to be concerned about is how they are going to unwind the balance sheet and what that's going to do for our interest rates. The third thing, rates are set to rise. I hate to break that news to you, but they're going to be higher year over year from 2017 to the end of it. We rose about 1/4 of a point on average. Next year, I think we're going to see that anywhere between 1/4 to 3/8 of a point. So I hate to say it, but the days of a sub 4% 30-year mortgage are coming to a very quick end. And then finally, we're going to look at what housing is going to look like, and will it continue to have its impressive run despite the tax reform, and will it be a drag on us as we go forward? So stock market, let's take a look. They appear very toppy and very vulnerable. Entering the new year, the investor optimism, we have hit a 30-year high as far as investor optimism goes. That's since 1987. That's actually an incredible run that we've had in the market. So I think, again, we could be set up for a very, very big change in the stock market. And I would look for that to happen probably towards the end of the first quarter, maybe by the beginning of the second quarter and going into the spring. The stock market also is at the most expensive point when it comes to a price to sale ratio ever. And let's take a look at this chart. This is the S&P. And right now, back in 2000, we hit that high. And if you follow that trend, and the charts don't lie, we are subject to a major change coming. I'm not saying it's going to happen, but there is the possibility of it. The market is absolutely pointing in that direction. Then finally, we're in the third largest stretch of expansion in history of the stock market. Pretty incredible news with which you have to all absorb if we do see any type of correction. Then finally, one thing I always like to follow are flattening in the yield curve. I always track the 10-year note, but I also look at yields between the 2-year and the 10-year note. And when we start to see that flatten, the next chart will tell you that once we do go inverted between yields, 10-year minus the 2-year yield, and it does get inverted, the gray bars are indications of us going into a recession. My concern is right now we're sitting at about 60 to 65 basis points. You know, only about a year and a half ago, we were almost at 275 to 250 basis points. Now we're trending back down. And as you can see, anytime we did go inverted, we hit these gray areas, and those were signs that we were going into a recession. So again, my prediction for 2018 is we'll see a good pullback in the stock market after such a huge 2017 and see people take money off the table and ultimately maybe reinvest it. And hey, who knows, maybe they'll be buying more houses too. So The Fed is going through a significant changing of the guard. Janet Yellen, old Yeller, is getting pulled out. Vice Chairman Fisher and President Dudley are also being have also been removed from the Fed committee, and now the president must appoint four new Fed governors for 2018. The hawkish dissenters that are part of the voting committee are out. So Neil Kashkari and Charles Evans are out. They are out of the voting committee, and a hawk, Loretta Mester, is in. And when I say hawkish, I'm saying that they are going to be rather aggressive when it comes to raising short-term rates. The doves are ones that want to sit back and just kind of let to see what the market is about to do. Here's the changing of the guard. Chairman Powell has been appointed. He is one of the he's a worldly man, a very, very economically sound person that's going to take over. And like I said, the president does have some work to do as far as who he's going to appoint and what is the makeup of the Fed going to be. My concern is if you have people in there that are going to put the pedal to the metal as far as raising rates to crank inflation up, well, that's where you're going to start to see the issue with inflation putting more pressure on the economy and thus leading us into that potential recession that we've been following with the yields between the 10-year note and the 2-year note. So the Fed dot plan, basically we have the members forecasting 3 rate hikes. They're actually very, very poor at forecasting it, but right now we're looking at least 3 rate hikes from what their forecast is. My prediction is a little bit less, but there's the Fed dot plot chart if you want to take a look at that. And you can keep that in mind as we move forward throughout 2018. Now, most important thing I think that can impact the market, and this is the Fed's balance sheet and what they're going to do. Right now, inflation is tame. The stock correction could limit the number of hikes as far as what's going to be happening with the Fed. But the fact of the matter is that since quantitative tightening has occurred, we have seen rates stabilize. Now, what the Fed is going to stop doing, and they already have, is start reinvesting their purchases and reducing their balance sheet at the same time, thus creating more supply in the bond market as well as the mortgage-backed securities market, and ultimately that will put more pressure on yields. As we went through the end of 2017, we did see the 10-year note move off of that 218 line in the sand, get up to 238. Now we're sitting at 247. And I think this is a direct correlation, as you can see right here, that we are starting to see a reduction in the Fed purchasing bonds in the secondary market, which ultimately help support our mortgage rates. So the balance sheet is, here's how it looks right now. Yeah, 1.8 trillion. That's pretty incredible. And they're only going to reduce it in 2018 by 120 billion, only 120 billion. But as you can see, if they continue to move along at the clip that they're looking at, the reduction of the balance sheet won't happen until 2025. I don't believe there's any possible way that they can continue to do this. We would be looking at a 7-year significant run as far as the economy goes. There will be a point in here when the Fed's going to have to get back in and start cutting short-term rates, as it has done historically, to keep the market going. So let's go ahead and move on now. The Fed, our prediction right now is to see at least 1 to 2 hikes, even if we see the stock market pull back. So let's keep our eyes on those couple of things. Some pretty interesting things going out of Washington right now. But again, the stock market is something we've all been watching significantly on a daily basis. So mortgage rates, obviously very important for us to follow. Inflation, and one other thing, the economy is the main driver of rates right now. Inflation is non-existent. Rates will ultimately move higher, but I do not believe they're going to be jumping anywhere between 50 to 75 basis points. I think you can see rates move anywhere between 1/4 to 3/8 of a point. The quantitative tightening situation right now, Fed is going to be reinvesting less. I think that's going to also put short-term pressure on rates. The stock pullback, though, like I mentioned earlier, could help support rates with money coming out of the stock market and going back into the fixed income bond market. It could help support our rates in the event that the reinvesting situation with the Fed goes away. And then finally, I believe the 10-year note is going to get up to 264 as a high. If we get above that level, it is a significant line in the sand. It could get ugly in the market. But right now, 0.375 is what I'm calling for on an annual basis for us to go higher as far as 30-year rates go. The housing market, let's take a look at what my prediction is going to be there. There is low inventory. We all are fully aware of that, particularly in the Shelby County area. I believe at this point, 5 or 6 years ago, I think there were almost 10 to 12,000 houses on the market. Right now, there are anywhere between 3,500 to 4,000 houses on the market absolutely incredible. Rents right now are also rising at a 4% clip per year, and that is something we also need to take into consideration. We've got some great tools for you to go in front of renters with to help them make a decision to ultimately purchase a home and the advantages of it as far as appreciation and building equity into something that you actually own. Rates modestly higher, but it will not derail the housing market just because demand is so strong, as we are fully aware of. So let's go ahead and take a look finally at tax implications. Whew, boy, we dodged a huge bullet with that 5-year exclusion. That's very good as far as capital gains tax. I was very concerned about that going into the last couple of months of the year. If they had moved that out to 5 years, what that would impact us as far as people selling houses and either moving up or down. But it is still 2 years, which is a good thing. But the deductions right now that you're able to take as far as a double standard deduction does make it more appealing for a renter from a taxable standpoint instead of purchasing a home. I'm not saying buying a home is a bad investment opportunity, but from a taxable standpoint, it is not as attractive. Thank goodness also we don't live in the 6 large states, California, New York, New Jersey, Illinois, Massachusetts, and New York, as far as the taxes that they are paying on property and the amount of money that you are allowed to write off in regards to that on your taxes. So glad to be in the Tennessee area where taxes are where they are, very comfortable and a good place to move. So finally, right now, my prediction nationally is to see the appreciation go up anywhere between 4.5% to 5.5%. Historically, right now, the state of Tennessee is moving along at about 2.9 to 3. I would see that I'd see that repeat itself from an actual number for the state of Tennessee in our area. Again, 2.9 to 3.2% appreciation as far as house appreciation goes. So Albert Einstein made a comment about compound interest. It is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. And the reason I say that is because just at a 4.5% annual rate of appreciation on, say, a $300,000 home, the resultant value over that term is a $166,000 gain in 10 years. So again, in 10 years is coming from the National Association of Realtors based on the fact that these are the numbers of number of years that people on average are staying in a home. So that's where we are right now for 2018. I hope everyone has a great year. We had a great year over here at the Deal Dugout. We've got some great new tools for you too this year to use to present to potential buyers, as well as to get in front of some people who are thinking about selling and give them the actual bare bones numbers rather than just giving them a basic answer of saying, oh, well, you build equity in something, or, oh, it's a great tax write-off. We're going to give you hard numbers to put in front of people to make it that much more appealing for people to think about purchasing a home going forward. This is Andy O'Fee, the Yankee Closer. I wish everyone health, happiness, and a great year as far as productivity goes. I look forward to working with everyone out there. Happy New Year, everyone. Thank you so much.